Hello and welcome to today's episode of Rise High Facebook Live. Today I'm joined by the wonderful Kristen Tunbridge, who is of course one of our SMSF self-managed super fund experts in the Rise High team, and also the wonderful Chris Harris, who's the director of Excel Super. And Chris, in my opinion, would be the number one expert in South Australia for self-managed super fund, and in particular buying property in self-managed super funds. So we are very excited to have both of these experts here today, because today we're talking about how to use your superannuation to grow your property portfolio. So specifically how to buy investment properties using your super. So that's what today's topic's all about. So we do have a lot of questions that have come in through the week that we're really excited to answer tonight. But if you have any questions that come up as we're talking, please feel free to type them in the comment section below, or you can email them to amanda@risehigh.com.au. So let's get into it. Hi Kristen, hi Chris.
Hello, Melissa.
Welcome. Okay, so I'm going to just throw over to Chris initially. And I think just to set the scene, before we get into everyone's questions, can you just explain what is a self-managed super fund and what are some of the reasons why people would consider setting up a self-managed super fund? Let's start there.
Okay, well that's probably the most appropriate place to start really, isn't it? So a self-managed super fund really is no different than any other superannuation fund, except that it's a structure where you as the owner of the self-managed superannuation fund have all the say and control over what happens with the self-managed super fund and what happens with the investments within that fund. I think it's really important to understand what a super fund is in general. And a lot of people make the mistake of believing that a super fund is an investment, but it's really not. All it is a blank tax structure that we hold investments within. In actual fact, superannuation is a trust structure that holds investments that we make, such as shares, bonds, cash and property. It just has a particular a concessional tax rate that applies to that particular self-managed superannuation trust structure.
So basically, instead of someone having their superannuation with an industry fund or a bank-run fund where they can't really control where their money's being spent, they put their super in a self-managed super fund, which means they have complete control of where their money's being spent.
That's absolutely right, because self-managed implies that really you're taking control, you're managing it yourself. Obviously you might need some help in how you do that, but at the end of the day you're the one that makes all the decisions about what the investment strategy is and how the fund operates.
Yeah, and I know that that's a really attractive feature, I think, of a self-managed super fund, obviously the control. It was definitely one of the reasons why myself and my husband went down that path, because we like to control our money and control our investments. So that's obviously one of the big positives. What are the other positives? And maybe let's also look at some of the downsides, just to be able to give a full picture of the pros and cons of setting up a self-managed super fund.
Sure. Okay. So some of the other positives, I think we need to reflect a little bit on that one issue of control. So what does control mean? It's been interesting lately. We've had a Royal Commission in regard to the banking and financial services industry, and one of the most alarming findings from the Commissioner is that banks and other organisations that run superannuation funds really don't have enough empathy or understanding for what it is that you, the customer, want to do with your superannuation. And really self-managed superannuation, which represents now over a third of the total amount of money that we have in our $2.5 trillion superannuation system, that money is there because people want to take back control and remove the influences, outside influences over what's happening with their money. And I think that that's a really positive thing. So the other things too that are really positive about self-managed superannuation fund is for people with larger account balances in superannuation, self-managed super can offer a very, very cost competitive structure for running a superannuation fund.
Yeah.
Something like, the statistics are really amazing, something like 87% of all funds that have $400,000 or more in them are now in self-managed super.
Wow.
So it's a big number. And the reason for that is because simply of the economies of scale that self-managed super offers with a fixed flat fee structure.
Okay, so obviously just to summarise the positives, we've got control, obviously flexibility over what you invest in, because if you do have a self-managed super fund, you can buy investment property, whereas you can't do that if your money's in a traditional fund. And also that it can be quite cost effective if you've got a larger sum in your super balance.
That's correct. And one other really important positive that we're going to talk about in depth today, and that is that self-managed super fund uniquely has the ability to be able to borrow money within it to purchase larger, a more diverse range of assets, including direct property within a self-managed super fund.
And that's definitely been something that we've noticed has been growing in popularity. Would you say that, Kristen?
Yeah, absolutely.
You know, people are becoming more aware of what you can do with your super, and, you know, borrowing money to buy an investment property in super has become a bit more popular as time has gone on.
Absolutely. If property is something you're interested in, and potentially you could exhaust other avenues of purchasing property, such as in your own name, then using your super is another way to do it.
Yeah, well, actually, that brings me on to one question. I'm just going to jump ahead because that's in line with a question that we got asked. So Matt actually wrote in through the week and he said, can an investor potentially have exhausted their borrowing capacity personally and yet still be able to borrow more money through their super fund to grow their property portfolio? So that's sort of along the lines of what you're saying. Can you answer Matt's question?
Yeah, absolutely. So we do find where people have used up all of their borrowing capacity in their own name, they can look to use their superannuation. So when you're looking at borrowing capacity using your super, most banks will only take into account the rental income that you receive from that property, plus the contributions that are going into your super fund. So that's usually a 9.5% based on your PAYG income. So it doesn't, in most scenarios, doesn't look outside of that if you can afford to service the loan just with those two factors. So
that's good because it's taking into account income that you wouldn't normally be able to take into consideration in your personal capacity. So just got a shout out to Rue, James, Stacey and Ryan. Thanks for tuning in, guys. Really appreciate your time. So we're going to go over to the next question now. The next question is from Amelia. Amelia asked if there's a minimum superannuation balance that people should have to consider setting up a self-managed super fund. Now, you've touched on balance a little bit, but let's explore that a bit more fully. And then I'd like to get Kristen to answer that question in relation to the lending side of it and what makes sense from a lending perspective if people are planning to set up their super fund purely for the purpose of buying an investment property. So firstly, Chris, what's your opinion on the matter?
Hi, Amelia. Thanks for your question. The answer to that is a little bit complex because the good news is that there is no minimum to set up a self-managed superannuation fund. So you can start it with $1. But the practical outworkings of that is that you really need to have a larger balance to make self-managed superannuation worthwhile from an economies of scale point of view and to justify the fees that you'll be paying in a self-managed superannuation fund.
So at what sort of balance level do the fees sort of make sense? Because obviously, you know, a lot of people don't even realise what their fees are in their traditional superannuation funds. Mm-hmm. So when we're talking about fees, you know, at what balance of your super would it make sense that you would probably be on par with the fees that you'd be paying in your traditional super fund versus your self-managed super fund?
Back in 2011, the Cooper Review, between 2009 and 2011, the Cooper Review investigated into Australia's superannuation system and found that approximately 2.3% is the average cost of running a superannuation fund, not just self-managed.
2.3% of the superannuation balance.
Correct. Every year in management fees to run a superannuation fund. Now, the superannuation industry believes that you need to have a balance of somewhere around about $200,000 to justify commencing a self-managed super fund. And that seems like a lot for a lot of younger people. However, one of the things that's really great about self-managed super is that we can combine our superannuation accounts with our spouse or with other people to reach that $200,000 level. The $200,000 isn't a hard and fast rule. but it's a good rule of thumb to determine whether or not it's actually going to be in your best interest to look at implementing a self-managed super fund as your superannuation solution.
Okay, great. So hopefully, Amelia, that's addressed your question. But I want to take it one step further with Kristen. I'd like to talk through an example of, let's say Amelia does want to set up the super fund to buy a property. How would the numbers work and what would she need in the fund to make it feasible for her?
Yeah, so I guess looking at a scenario of purchasing a property for around $400,000, you need to take into account the deposit required. Now, buying a property using your super does require a bigger deposit than if you were to purchase in your own name. So most banks require around a 30% deposit, so it's based on the purchase price. So going back to our scenario of a $400,000 property, a 30% deposit would mean you need $120,000.
Yep.
You then have the normal stamp duty, conveyancing, government charges, things like that, which wrap up into about $20,000-ish for that scenario.
Yep.
Bank fees, so there are quite a few more fees involved in setting up a loan with a self-managed super fund compared to buying it in your own name. So take around $5,000, potentially less, but let's just use that figure for today. And the other thing that's a little bit more specific to purchasing a property using your superannuation is that most lenders do have what they call a liquidity rule. So this is where they require about 10% of the asset value to be left in your super fund account in liquid assets. So that's cash or shares, managed funds, things like that. So the 10% liquidity rule on a $400,000 purchase price means you would need about $40,000 left in cash or shares in your account after you've purchased the property.
So what does that mean overall?
So rolling that up into, I guess, in line with what Chris was saying, for a $400,000 purchase price, you would need to have at least $185,000 in your super fund before you look at purchasing that property.
And like Chris said, you know, you don't necessarily need to have that on your own. You could have that with your spouse if you want to have a joint fund or with other people. So, yeah.
Well, as you know, Marissa, we have a number of joint clients who are brother and sister, for example. Who,
okay, is that quite common?
It is, yeah. And,
yeah.
You know, there's no real rule. There could be two good mates who are just passionate about property and who are really looking to get onto the property ladder, who want to combine their superannuation together in a superannuation fund to meet that $185,000 that they require. So that's pretty common.
And it could be, you know, thinking about that scenario where people are investing with friends or family members outside of their immediate family, so not their spouse, but brothers and sisters. You know, the self-managed super fund could be a good option, you know, as opposed to doing it outside of super where it's going to impact their borrowing capacity long term as well.
Absolutely. There is one other scenario that I might just mention at this particular point, which is really common, and that's when you get a couple of business partners who decide that they want to invest in the property that they operate their business from. So we might have two directors of a business who decide to pool their superannuation resources and make an acquisition of the property that they're operating their business from, and that's a really, really common and very, very tax effective way to be able to buy the property that you're operating your business from.
There's lots of different examples of how it can work.
Yeah,
that's
absolutely.
really interesting. Well, there was actually a question, I'm just trying to find it, I will come up to it. There was a question that came through the week. Oh, here we go, it's from Alice.
Hi, Alice.
So Alice actually did ask, when setting up a self-managed super fund, is it normally just husband and wife pooling their super together, and or can other people get involved? And she also asked if kids can join the fund when they reach working age. So we've sort of answered part of Alice's questions, but I don't think we've touched on the kids. So let's talk about that.
Okay, so again, it's a really common desire of people to be able to, if we're taking control of our own superannuation, why aren't we taking control of family members' superannuation within the self-managed super fund as well? And so it's pretty common for us to have a husband and wife team to look at adding, you know, some of their adult kids into the fund. And whilst there can be some complexities to how we actually operate the investment strategy within the fund to make sure that everybody's happy, but there is nothing to say that you can't add your children into the fund, providing that they're 18 years of age. So no problem there at all.
Excellent.
So we can have up to 4 members of the super fund, Marissa. I think that's an important thing for everybody to know.
Yeah, excellent.
Yeah, so at this particular point in time, there are 4 members that can be admitted to the fund. So you could have a husband and wife and 2 children.
Yep.
Or you could have 4 business partners. You could have husband and wife and, another husband and wife, 2 couples.
Couples,
there's all sorts of different scenarios that are available.
Excellent. Well, hopefully we've answered Alice's question.
Hopefully.
Shout out to Kelly, Sam and Riley. Thanks for joining us, guys. Really appreciate it. And now, moving on to the next question. Oh, Henry did ask a question about self-managed super fund loans. He wanted to know if they're more expensive than normal loans. You've touched on the upfront costs in your scenario. You said that they have a larger upfront cost.
Do tend to be a little bit more expensive than just a standard residential loan in your own name.
So what about ongoing costs involved in a self-managed super fund investment loan as opposed to a normal investment property loan?
Yeah, so I guess the biggest differential is the interest rate. So self-managed super fund loans do tend to be slightly more expensive.
How much more expensive would you say?
So at the moment you're looking at a 4.5% for just a standard residential loan. For a self-managed super fund, you're looking more like 6.5 to 7.5%.
Okay, so there is a substantial jump.
Yeah.
Yeah, but I mean, I guess it does allow you to do something that you would normally not be able to do. So you've obviously, I guess, when you're doing your numbers and working out if this is for you, you've obviously got to make sure you're using the correct numbers when you're doing your calculations.
And that's something that I can help you with.
Yeah,
absolutely.
Awesome. Okay, we've answered Alice's question. Now I think I'm on to Declan's question. And Declan wanted to know about a pre-approval process. So he wanted to know how he could work out how much he could afford to spend on a property, and he wanted to find out what the process was in getting a pre-approval and working that out, and if there was any cost.
Yep, absolutely. So a pre-approval is highly recommended. We can even go one step further. So before you actually go about setting up a self-managed super fund, we can assist you to do a pre-approval using your actual figures, but we don't need to have an actual trust set up. We don't need to have the business structure in place. And I think this is a really good idea, especially if I guess your goal is to use your superannuation to buy a property. You don't want to go to the expense of setting up a self-managed super fund only to find out that you don't meet the criteria to actually be able to borrow using your superannuation fund. So yep, definitely something we can assist you with and highly recommended.
Marissa, I'd just like to chip in there and sort of say that, quite often we would have clients come to us, and the reason they come to us is because they want to set up a self-managed super fund with the idea of purchasing a property. So it's part of our process to make sure that before we proceed to establish the self-managed super fund, that we would pretty much insist that they went and got indicative approval as to whether or not they can get the loan. So Kristen and I, we talk a fair bit about whether or not this is an appropriate strategy. Because one of the things we don't want to do is be committed to a path that we can't retreat from and then find that we can't complete on our vision of getting that property. So I think it's a really, really, really critical and sensible step for somebody to ensure that they know the end result that they can get before they start the process.
And it's pretty much a no-brainer that you can get a pre-approval at no cost. And that sort of gives you security or comfort that you can actually do what you want to do before you go to the expense of setting up the fund.
So in practical terms, when we work together to help clients look at this, they tend to come to us, we'll sit down and we'll take them through a process of determining whether or not it's appropriate for them to set up a self-managed super fund in the first place. Then as part of that process, it's, we get Kristen in the as part of that to determine whether or not we're highly likely to be able to get the loan approval.
Yeah.
And that way, before we even start the process, we know that we're going to be able to see it through to the end.
Yep. So definitely, Declan, get your pre-approval in place.
Definitely.
That's a bit of a tongue twister.
Yes.
Now Claire actually just wrote in and she wants to know what the cost of setting up and running a self-managed super fund is. So we've touched a little bit on cost, but we haven't sort of talked numbers. So can we just elaborate that a little bit for Claire?
Okay, so I'll keep my answer pretty short, Claire. The cost of setting up a self-managed superannuation fund is generally about $3,500. Now, that $3,500 pays for the establishment of the superannuation trust and the trustees with lawyers that we need to engage to set up the superannuation fund. So it's not cheap to set up a self-managed superannuation fund. Then we also need to take into account the ongoing costs of managing the self-managed super fund and doing the administration of the super fund every year. And that's where you would engage somebody like Excel Super to do that for you. We at Excel Super don't believe in DIY super, which often is what self-managed super is referred to. I've never met anybody yet who sits around, sort of getting excited about doing administration of the super fund. So they tend to want to outsource it to somebody who, number one, knows what they're doing, but number two, has the resources and the time to be able to do that.
And there's some pretty strict rules around managing your super fund, so you really want to be on top of the rules.
You do. And to be a trustee of a self-managed super fund, which you would be if you established one, the rule book is called SIS legislation, so let's not get bogged down in that because we'll all be asleep, but the rule book in regard to what we have to do is about that thick. So it's pretty important that we make sure that we comply with the legislation. So all of our clients come to us and essentially pay us an ongoing management fee for looking after their self-managed super fund. And depending on how much work they want us to do to manage that fund, it costs somewhere between $2,200 and $5,500
a year.
Yeah, just depending on what services they want to engage us for.
Yeah. And so I guess one of the processes that someone has to go through is to look at the fees that they're currently paying in their current superannuation funds and compare that to what the cost is going to be if they do set up a self-managed super fund, to make sure they've taken that into consideration when deciding if this is the right thing for them.
That's right, Marissa, because those viewers out there who are pretty good with numbers will have already worked out what I said before, was that the average cost of running superannuation being about 2.3% per annum. If we have $200,000 in our superannuation fund, then we're paying around about $4,600 already to run our superannuation fund. So all of a sudden, self-managed super starts to get quite
a little bit cheaper.
Quite
cost competitive.
Economical and cost competitive to run. And
At that balance of the 200,000 mark.
The other thing too is it's a flat fee, so it doesn't keep going up as our balance grows. And if we borrow money to buy a $400,000 property, the fee doesn't go up accordingly.
The value
either.
of the fund is a lot higher than.
Yeah, correct. So it can be really economical.
Yeah, awesome. So Ben actually wants to know what the rules and restrictions about renovations and home improvements for investment properties are. I think that's one for Chris.
Okay. Well, I know.
Is it?
I know that Kristen's a bit of an expert in this one as well, but.
Well, perhaps you can both put in your.
Oh yeah, I'll answer.
Take it
it,
away.
and I'll let Kristen correct me if I make any mistakes. I mentioned that the rule book in regard to superannuation fund is pretty thick, and this is one of the rules that we need to be mindful of. If we decide to buy a property in our self-managed super fund, it's a bit of a renovator. There is absolutely nothing wrong with doing that, but the rule book says that we cannot substantially change the nature of the property. So whilst we might be able to make repairs on the property, we might be able to replace the roof, the kitchen, we might be able to polish the floorboards, paint, and in some circumstances we may even be able to do some small additions to the property. But what we cannot do is substantially change the nature of the property. The other thing that's critical for us to keep in mind is that we can't borrow to do those repairs. We can only use cash that we have accumulated in the fund. So Kristen talked about the liquid assets that we've retained in the fund. We must use those liquid assets to be doing the putting the Bunnings kitchen in or putting new air conditioning in or whatever that might be.
Yeah.
Have I covered that pretty much?
Perfectly.
Right.
Yeah, excellent. Now also, Sophie wanted to find out, because one of the big advantages of investing in property is that you can leverage off the equity that grows as the property value grows and the debt stays at the same level. So Sophie's obviously heard that may not be the case in SMSF, and she asked two questions. Firstly, can you access the equity growth in a property that you've purchased in the self-managed super fund, which might be a question for Kristen, or perhaps Chris has something to say about that. And she also asked, she also said that she's heard a lot of lenders are no longer lending to SMSF. Is this true? So, part one, can we access equity in a property that we've got in the self-managed super fund?
Quick answer, no.
So that would be one
not
of the
an
big
option.
downsides.
Absolutely.
You know, so
once
it
you've paid down
probably,
the debt,
you know, it doesn't replace an investment property strategy outside of
No.
super.
No.
You know, if you are interested in investing, it's probably good to have a strategy outside of super as well as in super. Would you agree?
Yeah, absolutely. Marissa, I think one of the things that our viewers need to be really mindful of is that purchasing property within a self-managed superannuation fund is a great strategy to supplement your existing property strategy.
So it's not a standalone.
No, I just think it's a great adjunct to whatever you're doing already to accumulate wealth outside of superannuation. Because as Kristen said, if we pay down the property loan within our self-managed superannuation fund, which we ultimately want to do because we're looking at accumulating wealth,
Yeah.
we can't go and redraw that equity back out to buy our next property. We actually have to accumulate cash in addition. So that's definitely a downside. But if we consider why are we doing this in a self-managed super fund, we're doing it for the sole purpose of generating benefits for our retirement. So therefore it really forces us not to just keep borrowing and rolling the dice on more debt, but to accumulate equity in that property that we can use to fund our retirement income stream. So it depends on how you look at it as to whether or not it's a positive or negative.
Yeah, excellent. And the second part of the question was that Sophie was concerned that lenders are pulling out of the SMSF space. So maybe let's get your thoughts on that, Kristen.
yeah, I guess we have seen quite a large drop-off in the number of lenders that do have self-managed super fund loans available.
But they are still available?
They are still available, but
So
I
people
guess
can still borrow money to buy a
Yeah.
property?
they can at the moment, but it's definitely a watch this space. And if you are thinking about it, you need to get in touch as quickly as possible because it might not be around for that much longer.
Yeah, what are your thoughts, Chris, as to whether this, whether we're going to be able to borrow money in our super funds into the future?
Yep. Well, I know for a fact that we've got three of the smartest people in the world sitting here talking today.
Oh, you're
we're
very kind, Chris.
But we're not as smart to know what the government might be going to do. We've got an election coming up in the first quarter-ish of next year, and the rules in regard to superannuation, the one constant in life is change, isn't it? So those rules are changing, and I know that there's been talk about if there is a change in government, that there may be proposed legislation to remove the ability to be able to borrow in self-managed superannuation. So therefore, I think the best thing that we can do is, I'm cautious about saying this because it sounds like, it sounds like a bit of a sales pitch. It's not. My advice to people is if you are considering this strategy, you need to act sooner rather than later to ensure that you don't wait too long and then go to enact the strategy and have somebody
And the
like
rules
us
have
say,
changed.
we can't do it because there's too much risk that the rules are going to change
Yep.
before you can settle your property. So you really need to be acting sooner rather than later.
Yeah, yep. So there you have it.
Yeah.
Look, that covers all of our questions today. I guess just to wrap it up, there are pros and cons with going down this path of buying investment property in a self-managed super fund. Definitely it is a great strategy and there are lots of positives, and that's obviously why it's been growing in popularity. But there are some things that you need to consider, the additional costs and making sure it's the right strategy for you. So make sure that you get your own advice and make sure that it's really the right decision for you at the end of the day. But like Chris said and like Kristen said, don't procrastinate on this one because we don't know if we are going to be sitting here in 12 months' time saying that this is still an option for you. So right now it's an option. Take advantage of it if you're keen. That pretty much wraps up our session for today, and we are looking forward to seeing you at the next episode of Rise High TV. Thank you.
Thanks.